All right. So, as simple as that, we are live. I'm excited to chat with you, Brian. As a little bit of context, we were talking pre-show. You are the U.S. CEO and then also the Chief Strategy Officer at Openpay. Uh, for myself too, but people listening, can you describe what that means? What those each roles uniquely encompass, and what Openpay
Yeah,
is
sure.
trying to do?
Yeah, and thanks for having me, Mike. Appreciate it. So, Openpay is a company that's been around for about 8 years. It is in 4 countries: Australia, New Zealand, the UK, and now the United States as of this year. So, of the 4 countries, we have different legal entities. The US legal entity is actually called OPY. And I play a role at the global company across all those regions as the chief strategy officer. So, global chief strategy officer. And then for the US legal entity, I am the CEO.
It structurally, I'd love to learn a little bit more about this. When companies move abroad or they open up offices in new countries, do they typically set it up to where the office, the company headquartered, say in Australia, as OpenPay, would own each company in different countries? Is that generally how it's structured?
Yeah, it's common. There's a number of reasons why you might do things differently. In the case of what we do, the different countries have different regulatory regimes. And those regulatory regimes for lending, for example, impact how and where you set up your legal structures. So, we are in the US incorporated like many out of Delaware, but our headquarters is in San Diego. And we have obligations in every one of the US states because every state in lending has their own regulatory requirements, as well as, of course, there's federal. So in some cases, companies will make the decision based on economics, some in terms of demographics and really where their base is. In our world, there's so much regulation that it's oftentimes tied to, where the regulatory regimes are and whether you need to separate liability and lots of other things that are probably fairly boring for your listeners, like taxes and things like that.
I know you'd be surprised.
Got some accountants out there, do you?
Yeah. And what does help me understand the scale and what OpenPay is doing that's unique? Like how many, I guess, how much, however you measure that, whether it's revenue, employees, uh, yeah, whatever the
Yeah.
best measure is.
Well, let's start off with first kind of what we are, and that is a global diversified payments fintech. Let's break that down. Talked about global already. We're in 4 countries. Diversified. We have products that are in business to business. So businesses doing business with other businesses, buyers and suppliers buying things back and forth. We could talk a little bit about that. Pretty cool platform. It's a SaaS-based product or set of products, software as a service. And then we have our flagship product, which is our business to consumer product. So that's the payments that are this combination or hybrid, if you will, of what people are starting to understand is a buy now, pay later loan and traditional consumer loans. And those two things are actually very different in almost every way. And so we do most of our business predominantly today in the flagship B2C product. But as some of your listeners and viewers may see if they look online, we recently made some really big and exciting announcements on the B2B side. So that's going to be growing much faster through some announcements we just made. So we have thousands of merchants that are enabled with both of these solutions. So we'll start on the B2C side. For the buy now, pay later, we call it buy now, pay smarter product. We've got thousands in Australia. We're really just starting to get up and running in the UK. We just acquired another company that does these specifically for the auto service and repair industry. So that's starting to kick up. It's in the thousands of merchants that accept that. On the B2B side, we had originally a company that is called Woolworths in Australia. It's kind of like a Walmart here. It's a very large company, for those of you familiar with, Smart and Final or even Costco, where they actually do a lot of business with other businesses, not just consumers. That's what Woolworths is like there. We call them Woolies. Easier to say. So you have a buyer and a supplier. Let's say your supplier is really big and they sell sugar to restaurants that put them on the table, right, and use them for cooking in the back. That's our B2B product that helps all those suppliers of those things connect with their buyers, and the buyers are often in the thousands. So a good example, we just announced, well, let me just go back to Woolies. They have, I think, 10,000 buyers for Woolworths products, right? Imagine them being like a Costco or a Smart and Final or something like that, wholesaling too. They have retail too. We just announced HP. So now HP is like a Woolies, and they now have, as everybody here knows, lots and lots of buyers that are businesses, not consumers. And those thousands of buyers will onboard, and we connect the two. We help them connect. We help them onboard. When you're a business and you onboard another business, you have to check a whole bunch of things about them. Anti-money laundering, AML, know your customer, KYC. You have to verify address, verify ownership, make sure that the bank connections, like the automated clearinghouse ACH systems are working. All that stuff, that big headache, can take days for somebody manually. We automate all that. And then we help them with the flow of the funds between the two businesses. So actually the trade flows and then the terms. So a lot of your listeners might be familiar with trade terms like 210 net 30. You get 2% off if you pay in 10 days, and everything's due in 30 days. Otherwise, it's late. Well, in our B2B product, if you don't have the funds, your restaurant, we'll go back to that example, doesn't have the cash flow to say, hey, I could take advantage of getting that 2% discount by paying within 10 days. Not only do we have this platform that's helping the two parties work together on these, payments, but we'll actually lend them the money to get the discount. And then they'll pay us a little bit, but it's better than not getting anything. So now they're recovering that discount. So there's lots of ways that we can help businesses deal with other businesses when it comes to, trade flows and payments and things like liquidity. So we just announced in the US a deal with a company called Kyriba based in San Diego, coincidentally. And Jean-Luc and I, the CEO, are going to be now making this available to their 2,000 businesses. So that's a pretty big scale. When you talk about how big each parts of these are, the B2B part was really much smaller for us than the consumer, but that's all going to start to balance now as we speak. That announcement happened last week. So that's the B2B product.
Interesting. And that was an acquisition?
No, that's a joint venture we're doing with them, a partnership we're doing with them.
Got it. Separate from, also announced an acquisition of Payment Assist. Is that totally
That's right.
separate, but around
Totally
the same
separate.
time frame? Yeah.
A few months earlier, but yeah. So Payment Assist sits on the B2C side. So everybody's seeing all these buy now, pay later companies emerging. Afterpay, Affirm, Klarna, Sezzle, it goes on and on and on. It's white hot. It's one of the things that drove me to leave my former role as a partner leading Deloitte's payments practice globally to being here. Payment Assist offers loans within the auto service and repair world, right? So if you have to get your transmission fixed, buy that, spread it out over time, and they sort of own that space in auto service and repair in the UK. They're a UK company. And so that helps us get into this vertical even more than we were. Verticals are really important, really, really important. It's part of the formula of our success. And we'll talk more about that. But integrating into the technology from auto service and repair, healthcare, home improvement, education, being embedded within the technologies of those industries is really key. So if your car's up on the rack and the guy says, hey, sorry, Mike, your transmission's bad. We thought it was a couple $100. It's going to be $3,000, $4,000. And you're like, oh man, yeah, take it off the rack. I'll drive it till it dies. It's not worth it. At that moment in time, to be able to come in and say, well, here on the system that gave me the estimate of those parts, for example, the estimates come in through a dealer management system, as an example. I see the parts. I see that it's $3,000. I see that my installation that I've pre-established is, $1,000 for that item, for that transmission. I'm going to give the guy a quote, and right there below it, you can spread it out. So I'm providing that option to save the sale. So Mike doesn't, bring the car off and drive it unsafely down the road or whatnot. Really, really key, because it gets rid of friction and it saves the sale, right? Yeah. So that's what Payment Assist is. They're in the auto vertical. We do the same thing in healthcare and the patient management systems. We do it, throughout these verticals.
And is that how you see this? First thing I want to ask you is, why is this white hot now? I mean, this concept seems so simple in one sense. It's like, yeah, if something's expensive, spread it out over time. Why did it take till 2019 or whenever these companies started to become so useful? I mean, was it just lack of innovation, or it seems a little late in the game for technology companies to have built this stuff?
Yeah, so I think there's a number of reasons for it, but COVID and the push towards more, online alternative payments really helped it. So just to make your point, when I was at Deloitte since 2006 running the payments practice, I would see an installment. Really, that's what they are, is installment payments, various types of it. I would see a merchant coming to us, a big merchant, big US or global merchant, once a year going, hey, Deloitte, hey, Brian, which provider should I use for, installments? Once a year. And then maybe 3 years ago, twice a year. 18 months ago, one a month. 12 months ago, two a week. Something was happening. And that's really when I started to think, wow, there's something going on here, right? All right, so the evolution of financial services at the payment point, at the point of the transaction, has reached, and the capabilities and the experience has reached a point. At the same time, consumer adoption and willingness has reached a certain point. The maturity in the other markets that were already using these things for many, many years. I mean, you go back, Japan, Brazil, throughout parts of Europe. I mean, Australia is like the Fertile Crescent for buy now, pay later. A lot of these came out of there. We're just slow here. I mean, whether it was chip and pin versus, swiping the card, tap and go, all that, we're like way behind. We're Cro-Magnon in the US. Takes us a long time. The new real-time payment system here. Well, a lot of countries have had it for years. Anyhow, take all these three factors that I just mentioned, and the ingredients were right. And with COVID and people buying more online, the ingredients were right. The fintechs are now a major threat or opportunity, if they don't take advantage of it, to the traditional credit card industry. Early on in this trend, a lot of the credit card issuers that issue the cards to the consumers were thinking, well, this is a fad. It'll pass. Or if it does pick up, it's going to go slowly like crypto. This stuff never moves that fast. Well, it started to really pick up steam, and a lot of them went from I'm waiting to now jumping in. And now you can hardly find a bank that's not rushing to catch up. The fintechs have the advantage. Some of them, like you'll see us, will actually work with them. But that was a hard point to cross if you're a credit card company that, if some of the merchants are losing revenue by not offering buy now, pay later, they're going to pick somebody else if I don't offer it. So rather than trying to protect credit cards, which is now, and they're not going to go away. Let me be really clear. There's still a role for credit cards, but there's a big role in that whole wallet, if you will, for buy now, pay later that credit cards can't address. And I'll explain that in a minute. Now the big credit card companies are at the table, and they're either partnering, acquiring, or building their own solutions to stave off what is this, I think, there's no turnaround now. There really isn't. Consumers love it. Consumers that use it, I mean, our repeat usage is as high as 80%. It really is a great product. And I can explain for your users that haven't, or your listeners that haven't actually used it before, why that is. It has there's a lot of magic to it.
Yeah, as I understand it, and correct me, maybe fill in the blanks here. So I come to a checkout page online. I'm buying maybe sneakers. I don't buy expensive sneakers, but say the sneakers were $150. You go on and you could use a credit card like you typically would, or you can enter in the buy now, pay later interface, and that's going to ask you it's not going to ask you your credit card information. It's going to ask you your banking details, your ACH, like account routing. No, but either way, it figures out a way to collect money from you, and it spreads it out over time for no fee, right? Typically there's no associated fee to the customer, the end consumer, when they buy buy now, pay later. Tell me where I'm wrong, because I feel like I'm missing this a little bit.
Yeah. So there's a lot of things. The first thing you said is online. It's also at the point of sale in store, not just online. So it's important to understand that there are two different worlds. There is a world of buy now, pay later, as it's typically defined, also called pay in 4, where it's, generally speaking, you've got 4 installments to pay for something, usually over 60 days, too much. You pay every other week. From a legal regulatory standpoint, it is not considered the same type of, a loan. It's not considered a regulated loan the way that longer term, more installments are. That's just how it's evolved.
Is that part of the appeal, part of the reason why it's grown so much, is it doesn't have the shackles of the loan regulatory considerations?
For the ones that are providing it, yes, staying out of the regulatory regime and the cost of compliance it's a very, very different world, very hard to do. It's a lot easier to stay below that radar. But there's a problem with it for consumers. If you're buying something really big, 2 months is only 30 days longer than a credit card. Because let's face it, you pay something on a credit card, you get essentially 30 days, a month until the next invoice, and it's not really solving that much, 30 days. Helpful, but it's really a smaller piece. It's for buying t-shirts and tennis shoes if you're a teenager, or a 20-year-old. But the problem is, what if you're buying something more meaningful? Again, healthcare, root canal, auto service, that transmission, your roof is leaking, or your education costs. Okay, so for that's that other world, which has been traditional consumer lending. So there are big companies out there like Synchrony that offer products that are, you can go larger, you can go, tens of thousands of dollars, and you can go for longer term to pay it off. And that's just a traditional consumer loan. But they're typically in the high double digit interest rates, 27%, 36%. The credit cards get up there that high too, by the way. If you leave a balance on your credit card, that gets up there. So you got one world that'll help you with the more expensive things and go longer, but it's really expensive, a lot of fees, a lot of interest rates. And then you've got this world that says, we'll give it to you, no interest, but you only got 60 days and 4 payments. Now you say, well, how do they make their money? They either charge a lot of money to the merchant, or a lot of them make money off of tricks, traps, and gimmicks. So miss a payment, here we come, right? Miss a payment, now we're making all our money off of people that had a bad day, that are $1 short, a day late, and $1 short. Late fees. There's one company out there, they recently reported half of their revenue is from late fees. So they're taking advantage of people that are really struggling. We think that's wrong. And it's one of the reasons we're a very mission-driven company, as you'll learn about us. So you got these, clowns to the left of me, jokers to the right. You know that song?
Yeah.
So
is that a Beatles song?
Yeah, well, it's not the Beatles, but the question is, in the middle, is there something that can do better on those fringes for both people that need to go longer, and for those people that don't want a gimmick, and those people that don't want a high interest rate? That's what we solve for. So our product, Openpay, is a flat fee, a simple flat fee. It never changes. Consumer goes to the point of sale, that just like you were describing, they get instant credit, which is very powerful because you're making a decision at the point of transaction. Unlike a credit card that doesn't know where you're going to spend it, therefore how risky it is. It knows. It knows this is for tennis shoes. And there's a table and it says, okay, how risky are tennis shoes? How risky is Mike? And it takes all this information and it gives you an instant decision right there. Very powerful. Credit card, you took it out 4 years ago. I don't know what your situation is. I don't know where you're going to spend it. You might be buying handguns. You might be buying whatever, right? Fruit. I don't know.
Yeah.
So the power of instant credit is it's much smarter. It's much more relevant, contextual, makes better decisions. All right. So we sit in the middle with this flat fee. What does that mean? If I'm paying a flat fee and that flat fee never changes, it's incredibly powerful for the consumer. They know exactly what to budget. They know if they have a bad day, if they're $1 short, they're not going to pay back interest, right? Because those free products say, but the day you miss a payment, now you got to pay back interest as though you were paying a huge interest rate the whole time.
So in the example of the shoes, if you're buying $150 shoes, the shoes might come out to $160. You're now
much higher. Well, with ours, yes.
Yeah.
So with ours, let's this is really important. People understand interest rates and they understand how they can fluctuate, as we're talking about. They can be really high. More important than interest rate is APR, the annual percentage rate. The annual percentage rate may be coming from interest rates, but with a flat fee product like ours, you simply take the flat fee if it's $10 every month on top of that $160 or whatever dollar in your example, and you divide what the cost of the loan is on top of the baseline of what the product cost was, right? If you take an APR from traditional lenders, again, it will be 27 to 36%. There's a few that will be 14 to 25%, but most of them are up there in the 27%.
That's so
high. I'll come back to why they're so high.
Yeah.
Our APR is a single digit, 9.99 or less. So this flat fee is really small. So you say, well, Brian, how can you do that? I mean, why wouldn't somebody else have done this already, right? First time I saw this was my kid's tuition a few years ago. And they said, yeah, you can pay to it. It was a private school. We're going to add $5 or $10 each time you make a payment. I was like, well, that's not much, right? Helps me with my cash flow. I'll do it. So what we do to get that APR so ridiculously low is we only do this in huge volumes. We do it through big, I call them aggregators. So what's an aggregator? An aggregator might be an insurance company that makes it available to all their physicians and their patients, and they have tens of millions of customers. So you get really big volume. That's so that our cost of capital, where we get our money for our loans, is really low. We get really, really good rates, better than you'll see in almost any other case.
Because you're borrowing a lot of money, basically.
Borrowing a lot of money. And then we pick our verticals, our industries, very carefully. Back to the verticals thing. In education, you'll find that something like a trade school has high risk. I mean, it could be like 30% of the loans never get paid off. Why? It's actually not the students. I never knew this. It's actually the trade schools go out of business a lot.
Whoa.
Yeah, isn't that interesting? So we won't touch that. But you bring me the CPA exam prep, CFA exam prep, Series 667 bar exam, healthcare, provider exams, $2,500, $3,500. These future CPAs, they pay their bills.
Yeah.
They never default.
Interesting.
So now what I'm showing you is in healthcare, dentistry is great. We're less than 1% losses in our current markets around the world. In each of these verticals, we carefully pick where we originate our customers, where we allow these loans to happen. Loss rates are low. Volume is super high. Now I can come in with a ridiculously low APR as a flat fee.
Right.
And I do that, and I say, okay, Mike, you pay that off at 9.99 for your leaky roof, and you do a good job, guess what I'm going to allow you to do through the device, through the mobile device? I'm going to let you go elsewhere in a riskier industry and use our 9.99 or less product because I've originated you in a safe area. Now I'm going to take you to home electronics where it's a high loss rate, but now you replaced your leaky roof. Now I'm going to let you get that flat screen TV to replace the one that got damaged
Interesting.
for $500, $250. And that's the magic of what we're doing. And not everybody can qualify for an OP loan, but we generally don't say no. We say not yet.
Yeah.
We
So
say
yeah,
here's what you have to do to earn your way back.
it's like you're building up a customer profile for each person. So if they're transacting on lower risk categories, then you allow them to scale up and buy higher risk categories.
It's all
Yeah.
about the risk models. It's all about the science
Yeah.
behind knowing the person, building a profile exactly. And we work very closely with some of the most innovative, advanced solutions at the bureaus that allow us. We'll be making a more of a public announcement soon about one of the bureaus we're working with. But yeah, that's exactly it.
Are those? Is that very, very useful data? I wonder on the credit bureaus, right? We have 3 of them in the U.S. I think 1 or 2 of them had a major security breach not too long ago. I wonder how that evolves. Like, is that? I almost see your company when you have this transaction data for each person uh, having a higher integrity of data over time than the credit bureau was. Like the credit bureau knows when I get loans, what credit cards I have, if I have any moves. I mean, a lot of their data seems so sparse. I wonder if that starts to become antique. Like if you didn't have access to any of that, would it matter? Would you have enough just based on the person, where they are, what they're buying, how much they're spending, maybe what age they are? Um,
Look, a bureau has a ton of data,
yeah.
and they're developing new tools every day that are pretty sophisticated. It would be impossible, I would say, not even hard, but impossible to be as precise as we are within those what we call credit boxes. Not only the sub vertical, the sub vertical, the timing, the place, all that stuff, they are a critical part. Now, where your point is really salient, where it really hits home is in people that don't do a lot of transactions, that are not as much on the radar. Maybe, they're in more of a cash business. Maybe they're a waiter or an Uber driver who doesn't have a lot of accounts, has one deposit account, doesn't have a lot of credit accounts. We call them thin files. They're really hard to know anything about. And this is where you bring in data sources that are not just the traditional bureau, and you buy them, and you get patterns and things like that, and you source them yourself. You originate data yourself. But no, the bureaus are really, really helpful. And I think, Experian in particular, if you think about things like their Boost product, what they're doing is saying, we're not just going to judge you. We're going to tell you how to get your rate, your FICO or Vantage score. There's 2 of them. We're going to show you how to get that up. We're going to tell you what it takes and the things you could be doing actively, not reactively. That's huge, particularly for people that are these thin files that are maybe immigrants and just don't use the traditional financial system the way they did. You can have information coming from utilities. Did you pay your bills on time? Things like that. Really important. We use all aspects, aspects that are legal to use, and we take consumer protection extremely seriously, to the point where the number 2 person in the United States after I joined, my first hire, was Gary Stein from the Consumer Financial Protection Bureau. He was writing policy, setting policy for things like this at the regulator. When I told him what we wanted to do with this simple flat fee product that would really destroy the high interest rate guys and the tricks and the traps from the BNPL providers, he was like, I'm in. This is exactly, it's a mission driven, purposeful company and a great product it's going to keep people out of debt traps.
Yeah.
And so we take it very seriously. So we also have a former OCC regulator on our team doing compliance. Super important stuff, both the data, how it's used, and being responsible lenders.
Yeah, and an example of misuse would be you're collecting data you shouldn't be, or you're not you, but a company would be using data they shouldn't use based
You
on
got it.
some. I imagine there's some rules on race or sex or um,
All those things.
credit. Yeah,
All
some.
it goes
Yeah,
on and on. There are
yeah, yeah,
things
yeah.
that are particular to the military. If they're, it's called SCRA. If they're actually in active duty, there's things you can't do. There's regulations on how close. There was a big set of regulations that came out a few years ago called UDAP, which was about unfair and deceptive acts, and there was one called Card Act, which really focused on the credit card industry and the practices. I remember in college and going through and trying to give me free T-shirts and stuffed animals to take out a credit card. Right
Yeah.
now, there's like literally a perimeter around the university where you can't market, you can't give stuff away like that.
And is
They
that
really are.
because yeah, so credit cards, like, all right, so if you just kind of, if I think about a credit card business model, it's, hey, I'm going to sell into the merchants. I'm going to sell an integration into the merchants so that people can use a card that I'm going to sell to them. So people have the card, they have the account set up, and we have terminals at the merchants. The people can go to the merchants, they can swipe the card. As the credit card company, am going to pay the merchants on the spot, and then I'm going to hold a debt to the consumer. And if the consumer doesn't pay at the end of the month, sorry, stupid phone.
Do we have a caller? We have a question from the audience.
God.
This is live. Go ahead,
Oh
caller.
man. All right. The question is, how does a credit card company work?
What is a
Like,
credit card company?
I think of it because I'm so slow to label things as good or bad or evil, and I think, like, why is the business model of the credit card company inherently, or maybe do they creep into nefarious territory by by needing these rules in place in the first place to block them out of, like, how can they be so? Are people just so? Do we have an inherent, like, human flaw in that we can't predict financial projections in ways that are reliably good for us, and that there's this the idea of the predatory credit card that they're going to, I mean, where does that, how do you wrap your mind around, why do we need laws that block credit card companies out of colleges? I guess let's start with that.
Yeah, look, it is not, I'm going to say it is not the fault just of the credit card industry. They're not evil. My son, just when he became 18, I got him a credit card instantly, and we talked about responsible lending and don't buy things you can't pay off in 30 days, and we went through all that. And he's establishing a credit profile that will help him in life. It's not entirely, one-sided, but what I would say is, the law of unintended consequences. A lot of students, a lot of young, adults don't understand. They haven't been made aware of what is this thing called a credit file. How hard is it to get rid of something once it's on there? What is compounding interest? What is a debt trap? And so, on the one hand, the credit card companies are laying out the rules. They're all there. On the other hand, what we found is the rules were too hard to understand.
Yeah, yeah.
And now you could argue that, yeah, they made it a small font so that people wouldn't, look at it too long. You can argue all that, but at the end of the day, they put the rules out there. They felt they were playing by the rules. They would tell you the rules changed. The bar changed. Most, including me, would say it didn't go far enough, and we needed to do things. And so it's gray. It's a gray area, I will tell you. Now, are there more so than credit card companies? Are there buy now, pay later companies that are banking on people defaulting, not paying on time for their business model to work? I would say it's the majority. And that's how you get, because somebody has to pay for all these, there's no fee. It's free for the first X days. What happens on both credit cards and on those buy now, pay later loans that are in those two extremes where we sit in the middle? It's like an insurance policy. You got to have enough people to pay on time, right? And you're going to have some people that are going to pay late, and you have to charge an interest rate that's high enough to offset, right? The loss. And so you charge people almost like a tax, like Mike that's never missed a payment. And you say, Mike, yeah, you can get your transmission fixed so you can get to work. It's going to cost you 27%. And Mike's like, wow, that's high. But what Mike doesn't realize is for Mike, it shouldn't be 27. It should be
Right.
9.99. Mike's
Right.
paying for Susie and Bob and Harry and Carol, right? Because they're defaulting and they're at maybe 27% also. And Mike's now subsidizing what should be a 36, a 40%, 100%, because those people have a very high or almost certain chance of not paying. Other countries have dealt with this. What we're doing is we're saying we're going to work in the middle and then we're going to work our way out. In other words, we're going to get that gap I talked to you about. What other countries are also doing, and you're going to see this here, Mike, is they're creating affordability and ability to pay rules. That will come here. I'm almost certain.
So
What
that
means
idea,
is,
yeah, go ahead. I'm curious because if you have an upfront fee and somebody is late, you have to charge them something. You have some incentive for people to pay on time, right?
that's right. Now we believe it should be just a small amount. It'll be
Right.
like $7 or $10, and we're going to limit it. Here in the U.S., we're going to limit it to 2 times. I mean, it's like,
Right.
all right, we need to have something there, but we're not making a living off of it. In
Right.
fact, it's not even covering the losses. It's on us to make sure we make good decisions on who we lend to. So we have to be more careful, more precise. Somebody at 27%, they can give out these products to anybody for anything they want to buy, right? And that allows them to be these massive companies that you see. But that's not our goal. Our goal isn't to be massive. Our goal is to make sure that Mike's not subsidizing a bunch of other people that maybe have no intention to ever pay, or maybe they're in a rough position. We can't afford to give these loans to everybody. Now, these other regulations are going to come to the US where they're going to say it's your responsibility, lender, to analyze if Mike really had the ability to pay based on what you should have known. We're not going to just put it on Mike. We're going to put it on you too. And you can't just charge higher fees to get out of it. You need to know what the ability to repay is. And that is difficult. Let me give you an example of airline pilots. These guys make a lot of money. A couple $100,000 a year in a commercial airline is what I think I heard. COVID hits.
Yeah.
There goes their ability to pay, right? So, you could argue that's a black swan event, a pandemic, but the reality is you don't know.
Yeah.
So it's challenging to say what's somebody's ability to pay. Well, he's always made $200,000 a year. He's always paid on time. It's not his fault. His behavioral attributes haven't changed. So the behavioral models still say he's a good risk, but something around him changed. The industry shifted, something that was out of his control. So it's a really important conversation. It's not an easy answer. I can't sit here and tell you that I've got the silver bullet for that. But I do believe what's going to happen is the results of all this. Most of these pay in fours that you see that only allow you to make stay below the regulatory radar, they will be out of business in a few years. I will.
This is like
bet dollars for donuts.
Klarna. You mentioned a few in the beginning that sounded familiar. Klarna and
yeah, I'm not going to
other
say
guys.
which ones are going to be out of business because I don't want to get lawsuits against me.
I want official.
Yeah, I think that category will either merge with traditional lenders or they're going to have to start getting regulated. And the challenge is almost all of them don't have a profitable product today. We're building a company based on a profitable product. They already struggle to be profitable. When you put the cost of compliance on it, they're going to have to either go into our space, merge with a big maybe credit card company or a bank, or go out of business. They need scale. They need to keep feeding the engine with tennis shoes and T-shirts. We don't do that. We really don't focus on T-shirts and tennis shoes for teenagers. We focus on average $1,000 to $1,200 transactions that go out for 2 years. It's the mom and dad putting braces on their kids. Again, it's the guy or the woman that's getting her CPA exam, that's prepping. And then when they're safe, I'll take them to those other verticals. It's a different model.
Yeah,
Completely different model.
yeah. The idea of shifting around whether you charge an upfront fee or higher or lower interest rates, that seems easier to change from a business model standpoint. But integrating which each of the different verticals seems really hard, right? Because you're probably integrating with the software that the dry cleaner, the dentist, the car
You got
repair
it.
man is using. So that's a
That's a
much
high
bigger
upfront cost,
much
right? And
bigger
that's where
moat
we
too. Yeah.
That's right. It creates moats and walls for the castles. That's exactly what I call them, is moats and walls. It's sticky.
Yeah.
So once you're in, as we are, Easy Vet, we'll be going live. This is public knowledge in about 60 days with Easy Vet, 1,200, veterinarians across the country. Will be integrated into that patient management system for those pets when they get their care.
Mm,
The dealer management systems that we were talking about. That's very expensive, takes really good integration skills,
mm,
just being part of that. Insurance companies, will be integrated into WorldPay at all the points of
mm-hmm,
sale.
mm-hmm.
Very expensive and time consuming. It's taken us a year to get
Yeah.
integrated into the WorldPay solution.
So, all right. So let's fast forward this a little bit. There's a lot of verticals out there. Say you just knock them all down. You knock a lot of them down. You're like, great. We have integrations into these verticals. Therefore, we're collecting data on profiles from people across many different verticals. We can see when they buy shoes, pets, dentists, cars. You have a much bigger picture of people. People are now able to buy things and spread the payments out over a longer time span. Does that then lead to the next horizon where you say, okay, because we have all this, we can now do something bigger or different? That, I guess one way of asking this is, are other countries already doing something that is going to be obvious in hindsight here in the US?
Well, look, I think the next generation of buy now, pay later will incorporate rewards and loyalty,
Mm,
and will catch up with and or integrate into the credit card loyalty programs and schemes that are already consumers here love. We have a particular addiction to loyalty and rewards here in the U.S. The affinity programs. I do think that will be one of the next ones. When somebody needs to buy something, um, they also have the potential to become savers towards that item or those
mm,
items. We do a lot of non-discretionary, which is unplanned. Get a root canal. I don't not too many people plan on a root canal,
mm,
um, or your alternator that goes out. But there's also a lot of people that are doing things. I drive this truck and I outfit it for outlanding. I love it's got all sorts of stuff on
nice.
it, and I plan my stuff out. I'm like, look, the next thing I want to do is X, Y, Z. Now, I think the next generation of what we do is to look forward and say, if we can get people that are going to plan for it and then do buy now, pay later, you start to get into sort of a almost depository, prepaid-ish sort of hybrid model.
Mm,
I think that's going to be really interesting in this space. I love that because you're really embracing um, this our ethos as a company of safe lending, but really a more financially savvy, educated consumer that's taking responsibility for what they're going to buy,
yeah.
not just how they're going to pay off what they're buying at the moment.
Yeah.
And that's going back to the data. If you can tell me right now, these 1 million consumers are like that, they're planners,
Yeah.
they're budgeters, and then you bring them to me at the point of sale, wow. Think of what I could do to them. I could probably give them a 5% loan.
Yeah, man, that's interesting. I want to throw something out at you and see what you think of it. So, one of the things I think that's interesting in crypto and blockchain is that you can move money around without the centralized decision maker. And
Right.
one way I could see that being useful in this application is if a company were to, it could probably remain centralized, but say a company were to have access to data, or food for thought, it's just decentralized. So you have these anonymous profiles that have data sets being like, I bought shoes at this location and a car at this location, and we don't know who the person is, but it has some generic stats about them, maybe their age or their transaction history, and they're now trying to purchase a $500 video game console. and they're putting their bid out on the network, and they're saying, hey, I'm requesting a loan from the network. I'd like $500 to purchase this from Microsoft. And the network can come back and say, okay, we have a collection of 42 funders on the network that approved your bid. So instead of your source of cash in Openpay being what it is, you have this kind of a decentralized source of currency, and people can kind of accept these bids and then fund that transaction on the buy now, pay later side. So basically, the innovative aspect of it is that the decision making process of the loan is decentralized, where people have access to approve this micro loans, if you want to call them that. And your source of funds is now individuals instead of one centralized location.
Well, you baked a lot of innovation into that. Let's start with, because the last part was interesting too, which is you're sort of bringing the lender, right, out in, like, there's platforms out there that do that, right? GoFundMe kinds of platforms and things like that.
Right.
Let's put that one aside. Let's just go with the idea of taking data about a lot of people from a lot of companies, putting it up there so that everybody can benefit without crossing any lines on confidentiality. Is that sort of the basic concept?
Yep.
Okay, you've just defined a credit bureau.
True, but there's more to it, because there'd be more than the data. There'd be the ability to move money from individual wallets to other wallets. So I can move money from, like, my wallet as a micro lending person to the merchant, and then instead of them holding the debt, it would be the person who bought the PlayStation.
Let's put the debt aside, because now let's break into layers what you're saying.
Yeah.
So part of it we talked about is sort of what the bureaus do, and they don't just take transaction data; they're pulling data in from different sources. Some of these companies pull data in from phone records and utilities and other things. So it could get better, but let's just say that data piece is fixed. Now the next layer you're talking about is, how do we move the money around regardless of the type of payment, whose it is, where it goes, right? That layer, that transaction layer, is what payments processors do today. Now, it used to be that if you wanted to get your method of payment, Mike Pay, Alipay, WeChat Pay, Apple Pay, whatever it is, you wanted to get it integrated into that lender. It used to be, well, yeah, maybe in 10 years, 20 years, we'll add you. We've got Visa, MasterCard, Amex. Discover was like, please, 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 we created our own network. Now Discover got in, right? Then it became picking up the pace. And actually, when I was at Deloitte, this was a project I was doing, is helping the merchants integrate and find a processor that would take that headache away from them. So the processor would go out and go, we're going to hook up all the pipes of all these different types of payments. And now they're looking at cryptocurrency. Merchant, you don't worry about it. We're going to give you one pipe. We're going to take all these in. So this year there might be 1, 2, 5, 10 new payment methods. It's our responsibility as the processor to take that load off of you, so you don't have to guess which one to, because it's very costly for a merchant. But as a processor, you're doing it for millions of merchants. That's your business model. So I would argue that it's not perfect, but onboarding new payment methods, including now we're going to see increasingly crypto, that layer is going to be taken care of by the big processors in the world. So companies like Adyen and WorldPay, which is now an FIS company, and Fiserv, which is now a First Data company, or First Data, which is a Fiserv company, I should say. A lot of these guys are merging. That's sort of their responsibility as acquirers and processors to take care of that for the world. All right, so we got that layer fixed. Now let's talk about who does these who provides the micro loans, and that's the really cool one that is not yet established or mature, because they are out there. There are ways that you can go online. I think the challenge there is trust and reliability on both sides of the equation. It's a really hard thing to do, to score and build the trust in the party that's giving the money into that pool. So it's easier when you say, you know what, kind of like a REIT, you're not going to know which property you're investing in, and therefore we lower your risk because we're giving you a lot. So there's I'm going to make this up. There's 200,000 musicians out there, and they're developing really cool new whatever, boxes for music or instruments.
Yeah.
Right? You want to invest in that? It's like a mutual fund, right? Now you can lower the risk, right? So you have an intermediary sitting in there. Can you put that in a cloud and have that trust? That's the big question. Who plays that role? If the investor was looking at a bureau, I think today at least they'd trust it more. Putting it in the cloud and saying, I'm going to put 10, 20 grand, 100 grand, $1 million of our family business into that.
Yeah.
Maybe not.
Yeah.
Will we get there? Hey, maybe, Mike. I mean, you've started a bunch of businesses.
Yeah.
Maybe they'll trust you.
Yeah, I have no idea if this is a good idea, but it just kind of came to me as you were talking as like a unique source of merging the data, the ability to move money around, the source of funds in a way that, because I think about how blockchain can be, how crypto can be useful in engaging some of the more common means of transacting, like this buy now, pay later. Which is so subtle. It's like on one hand it's so simple, but on the other hand it's so is credit cards. But they became massively large and successful with a relatively simple business model, and it's all how they executed it and got the terminals out there and did it.
Yeah, that's right. I would leave though one thing, if all of this is confusing your listeners, is instant credit at the point of sale, not meaning necessarily the terminal, but online. Instant credit at that moment is really the fundamental thing that's happening here that's so powerful for the reasons I talked about.
Yeah.
And credit cards don't do that because they've already given you credit before, or they may not be available to you in your wallet for a whole host of reasons. Maybe you couldn't qualify before. Maybe you didn't bring your credit card with you. Whatever the reason is, the power that we're talking about for this buy now, pay, I call it buy now, pay smarter, which is no tricks and gimmicks, can go up to $20,000, up to 2 years, and you're now covering a big part of the most meaningful spend in life. And doing that at a single digit reasonable APR that's not usury, that's buy now, pay smarter.
Yeah.
And instant at the point of sale. And that's what we're doing. That's cool. What my company is doing.
I love it. You're very good at explaining things too. I've interviewed a lot of people. You have a really clear way, an interesting way of explaining things with examples, and it's articulate. I appreciate that a lot.
Can you tell my wife and kids that? I don't know if they agree.
You have to have them listen to the show. Man, I feel like we could go on for another hour. Maybe we'll have to set up another time to talk about other things. But
we can talk after, in 60 days, once we finish our US launch. I mean, again, we're in 3 other countries, but things could get interesting as well. I think our name is going to become a household name pretty quick in the US because of these aggregators we're signing up, really big companies and names that all your listeners, and viewers for a few of them will know. So let's chat again in a couple months, and I probably have more to share with you.
Yeah. A big part of the reason I do this show is to dig into the nuts and bolts of how companies work and how people think about products and services and strategy. So I really appreciate your time, Brian. I think you commend you on all your progress. So hope to have you back on, man.
I'd love to come on. Love to have you on my podcast, and I'll send my folks over to your channel here, and we can intermix our friends and family here.
Cool. All right, man. We'll have a good one.
All right, take care.